Hello again. Let's continue with part 2 of the lecture. Now, the third type of decision making that we're going to look at is product mix decision under constrained resources. If a firm has unlimited resources and the demand for each product being considered is unlimited, then the product mix decision is simple. The firm can produce as many products as they want. Unfortunately, every firm faces limited resources and limited demand for each product. These limitations are called constraint. Well, there are two types of constraint. External constraints are limiting factors imposed on the firm from external resources, for instance, market demand or material availability. In the external environment, limits can include the economy itself, value chain limits, the market in general, and specific market for your type of product, associated regulation, and politics situation. Another example will be pandemic situation that we have. Internal constraints are limiting factors found within the firm itself. For instance, machine hours or labor time availability. Internally, this can mean strategic choices for the company in terms of personnel, equipment, space to use, materials, utility availability, and funds to be used in the business operation. Other constraints include an internal policy constraint. In short, a constraint, or sometimes we call it a bottleneck, can refer to any process, part, or scarce committed resources that limits the overall capacity of the company. Decision for the company under constrained resources need to include relevant costs. The general rules for product mix decision depends on whether the firm has constraint or not. If a firm has no constraint, the manager needs to select the products that contribute the highest contribution margin per unit. However, if the firm has capacity constraint, they need to modify this general rule to include constraining resources. Instead of using contribution margin per unit, now you need to choose the products with the highest contribution margin per unit of the constraining resources. You then need to rank the product based on contribution margin per bottleneck or per constrained resources. Let's have a look at an example here. Funride produces bicycles. The machines which produce the frames have a monthly production capacity of 1600 hours. It takes 2 hours to produce a mountain bike. Road bikes are more complex and require more exacting conformance to specification and take 4 hours to produce. So let's stop here. What are the limiting resources or the constraint that the company faces here? First, production capacity maximum 1600 hours. So that's the internal constraint that they have. And you have two type of product, road bikes and mountain bike. Let's continue reading. The monthly demand for mountain bikes is approximately 500 bikes, while the demand for road bikes is approximately 1000 bikes. So here you have a maximum demand for every month for each type of product. So this is another constraint that you need to consider. Mountain bikes sell for $400 on average and road bikes for $500. The variable manufacturing and marketing costs are 280 and 300 respectively. The fixed costs for Funride are 700,000 per year. Now, two questions for you here. First, what product mix should Funride aim for? Then the next one is calculate Funride's monthly profit under this mix. First, we need to calculate contribution margin per unit of different product. So for mountain bikes, selling price is $400, variable cost $280. Therefore, contribution margin is the difference, equal to $120 per mountain bike. For road bike, $500 selling price per unit minus variable cost per unit $300. Contribution margin is then $200 per unit. If you look at the contribution margin per unit, by selling one unit of mountain bike, you will get $120. Uh, from road bike, you will get $200 per unit. Therefore, if we look at CMU, contribution margin per unit, road bike will give you more contribution margin compared to mountain bike. However, we need to consider that the constraint that the company has is the machine hours. Now let's consider the machine hours for this product. Machine hours to produce one mountain bike you need 2 hours and road bike you need 4 hours because it was said it's more complex. Now we need to calculate contribution margin per constraining road resources. In this example is the machine hours. 120 divided by 2, it is $60 per machine hour for mountain bike, and for road bike it is 200 divided by 4, it equals to $50 per machine hours of road bike production. Well, because mountain bike has a higher contribution margin per machine hour, then we want to maximize monthly demand for mountain bike. It was said that we can sell up to a maximum of 500 mountain bikes. So we produce 500 mountain bike first. So with 500 mountain bikes, we need to calculate how many hours will be spent on mountain bikes. So 500 times 2 hours per unit, it equal to 1,000 hours will be spent on producing mountain bike. Then the remaining of maximum production capacity for this company, 1600 minus 1000 equal to 600 hours will be allocated to manufacture road bike. Now the question is if we have 600 hours, how many road bike that we can produce? 600 divided by 4, it equals to 150 unit of road bike. So here is the product mix for these two type of bicycle. 500 for mountain bike and 150 unit for road bike. So that's the answer to the first part of the question. Next, we need to calculate how much monthly profit that we can get from this product mix of two type of bicycle. Now we need to calculate the total contribution margin per different type of product. 500 bicycles times how much is the contribution margin per unit, which is 120. So 500 times $120 equal to 60,000 total contribution margin from mountain bike. Then from road bike, you will get $200 per unit times 150 bicycle equal to $30,000 contribution margin. So total contribution margin from these two type of bicycle equal to 90,000. Remember, from contribution margin is it will be used to cover the fixed cost. How much is fixed cost for this company? Fixed cost per month equal to $58,333. How do we get $58,333? If we can go back from the previous slide, fixed cost for fun ride are 700,000 per year. So 700 divided by 12 equal to $58,333. So the difference will be the profit for that month. So for every month, because this is monthly product mix plan for the company equal to $31,667. Let's have a look at the exercise taken from your textbook, exercise 13.29. It is on product emphasis and constrained resources. Emily developed an innovative computer game called Home by Myself, or HBM. It was so successful that she quickly followed up with two sequels, Home by Myself 2 or HBM 2 and Home by Myself 3 or HBM 3. The cost of developing the games were 95,000 for HBM, 10,000 for HBM 2 and 15,000 for HBM 3. The production process consists of copying the games to blank DVDs using her computer, then packing them with printed instructions in the display box. It takes longer to copy the original game than the sequels. Emily can produce, ready for shipping, about 20 copies of HBM, 30 copies of HBM2, or 45 copies of HBM3 in an hour. So what is the capacity constraint here? You need to think about the hour because clearly Emily has a different output for different hours that she will spend in the production process of the games or DVDs in this instance. Now this is the data. So for HBM 1, 2, and 3, you have different selling prices here. Cost, you have blank DVD, $1.50, $1 for HBM for the sequel, 50 cents each. Instruction and packaging, pro rata development costs with a bit of note there, A. So let's read what note says. The pro rata development costs were determined for each game by dividing the game's development cost by 5,000, the estimated minimum total demand for each game. Okay, so that's the development cost. Then margin for each product is HBM $25, HBM 2 $25.50, HBM 3 $23.50. Okay, if we look at the profit margin for each product, it seems that HBM2 gives you the highest margin. But remember, we have constrained resources. Daily demand is 120 games for HBM and HBM2, and HBM3 is 90 games per day. Now, first requirement. What is the contribution margin per hour of Emily's time for each game? So that's part A and part B. In what order should Emily produce the games? First, we need to calculate contribution margin per hour. Contribution margin per hour. HBM equal to 49 selling price minus $5 is the variable cost, time 20 equal to 880. Next, with HBM2 equal to $29 selling price minus 2.5 variable cost time 30. Why 30? Because she can make 30 DVDs in an hour equal to 795. HBM3 equal to $29 minus 2.5 variable cost times 45 DVDs because she can make 45 DVDs in an hour equal to $1,192.50. The development data here are not included because they are sunk costs, therefore no need to be included in the analysis. If we look at the contribution margin per constrained resources here, in this case is per hour, we can rank these three products. So first we should emphasize HBM3, then HBM, the original, then HBM2. Part C, using the general decision rule for constraint capacity, what is the most Emily should be willing to pay per hour for a worker to duplicate and pack disk after her normal working hours. Assume that the worker would work at the same pace as Emily. Now, let's assume 8 hours working per day. First, need to produce and sell 90 games because maximum is 90 games daily demand for HBM3. It will take a total 2 hours, 90 demand divided by 45 per hour. Then produce and sell HBM because HBM is the second highest contribution margin per hour, which takes 6 hours. 120 demand divided by 20. There are no more hours left after this. However, since the contribution margin per hour for HBM2 is 795 per hour, Emily could spend up to $795 per hour for 4 more hours to fill the demand of HBM2. If Emily is unable to hire part-time help, she will still be able to pay 3,180. That comes from 4 times 795 per hour for an 8-hour day and let the worker do other things for 4 hours. So that's the end of this activity question. Let's move on to the fourth type of decision, that is keep or drop decision, part of this business. It can be a product line, can be a business segment, can be different customer groups. So when organizations provide multiple products, either goods or services, they periodically review operating result for each product, group of product, or we call it product line if you like, business segment or customer segment, and decide whether to keep or drop the product or segment. Note that decision should be based on profitability, not how much revenue a customer group or business segment or product line can generate. It means we should also consider all relevant costs associated with the product or segment being reviewed. The general rule is we can discontinue a product, service, or business segment when its total contribution margin does not cover avoidable fixed costs. Therefore, to consider this keep or drop decision, you need to think about relevant costs or revenue. Relevant costs or revenue in this case are those that will change if you drop product, service, that segment, or that customer group. Fixed costs in this type of situation are not always relevant. You need to consider the nature of the fixed cost itself and their relation to the two alternatives. Either you want to keep or drop this segment or product. Then think about whether you have direct fixed costs. Can they be avoidable? And common fixed costs, for instance, manufacturing facility that produce a number of products, is unavoidable if only one product is dropped. So if it is unavoidable, then it is irrelevant to your decision whether to keep or drop that type of product. And if we apply this concept into considering customer profitability, we need to be mindful that not all customers are equal. Consider the cost associated with new customer and existing customer. So they can incur a different type of cost in terms of managing these two different type of customer. And think about higher or lower sales revenue that you generate, whether they are the full price or net of discount. And think about the sales revenue that you make. It is a full price or the revenue that you make is net of discount. Because for new customer, some companies like to offer discount to expand or gain them a new market. And you can also sometimes can get discount if you want to buy large quantities from the company. And other customer costs that we need to consider can be the packaging, whether the customer require special packaging or they're just happy with standard packaging, and the level of customer support that you need to give them, and distance, how far you need to deliver the product to the hand of customer. Usually this longer distance associated with higher costs, and batches too, smaller batches associated with higher costs, terms of trade of the sales, and whether you provide return policy to your customers. Example, another things to consider. Decision rule for in assessing customer profitability will be whether you want to add a customer group or drop a customer group. And think about whether adding or dropping a customer group will add operating income to the firm. If it add, then do not drop them. If it doesn't add operating income to the firm, then you might continue your assessment whether you need to drop this type of customer group. Remember, decision is based on profitability of the customer, not how much revenue that a customer group generate for you. If you want to drop a customer group, the costs that you can save include cost of goods sold, associated warehouse costs, labor, marketing support, order processing, and delivery processing. But you will lose revenue from this customer group. But what about general admin, corporate office, warehouse space? Are they avoidable? Will they not be incurred if you drop a customer segment? You need to investigate this type of cost further. Therefore, managers need to separate relevant and irrelevant cash flow. If financial statement data are simply taken and used in this calculation, average costs are often mistakenly included as relevant information. So we need to look at the breakdown of the cost data. We need to investigate which ones are relevant to keep or drop decision. Let's have a look at an example here. It is on segment assessment. Builders company, it has 2 branches in Cranbourne and Hallam. Revenues for Cranbourne, it is 1,070,000. Hallam is 160,000. If you look at the bottom line, Hallam is making loss $25,000. Cranbourne made profit $70,000. So if you look at this data, looks like Hallam needs to be dropped because, well, it's making loss 25,000. But before we make a final decision, let's look at whether we have fixed costs that can be avoidable. The last line for the expenses, you have allocated corporate overhead. Additional information related to this one, assume that only 20,000, i.e. 10,000 for each branch of the allocated corporate overhead will not be incurred if any of the branches are closed. So for Cranbourne, allocated corporate overhead is $50,000. For Hallam, it is $40,000. So in total, allocated corporate overhead is $90,000. Question: what cost will be avoided if the Hallam shop is closed? Now we need to modify this calculation to take into account the fixed cost that can be avoided. Corporate overhead for Cranbourne 10,000, so this one can be avoided if one of the branches is closed. Same with Hallam. Then total of these 2 branches are 10,000 each. 20,000 corporate overhead that are allocated to two branches. Therefore, unallocated corporate overhead is $70,000. So in total, still the same. This is just the total of the result from two branches. Revenue is a total from Cranbourne and Hallam. Total segment operating profit here is 115,000, because if you take 10,000 allocated corporate overhead for Hallam here, it seems that Hallam is still making profit or contributing 5,000 profit to help the company to cover 70,000 unallocated corporate overhead. In total, 115,000 from two segment profit that they made for the year to cover 70,000 unallocated corporate overhead. Then the company itself still can have a 45,000 profit. Now, what will be the effect on the company overall if Hallam is closed? So let's take the column for Hallam calculation out of the picture. Then here's what we will have. Revenue only from Cranbourne branch for now, so total 1,070,000. All the expenses from Cranbourne only. Then to cover unallocated corporate overhead, 70,000. Therefore, total expenses will be 1,030,000. Net profit now equal to 40,000. So compared to the previous one, net profit will be reduced by 5,000 because they're losing all of this profit on all of this calculation contribution from Hallam. Now, implication. If we close Hallam, it means, well, it is the unprofitable shop. It reduced the profit as a whole, the profit of the company as a whole. This is based on the quantitative analysis. However, now you need to examine whether the impact of fixed costs allocated to segment, can they be avoided if segment will be removed. Okay. The fixed cost that you allocated to each segment, just make sure that you can really avoid these expenses or fixed costs if you really want to drop this branch. However, remember, this is only based on quantitative analysis. In addition to this, equally important is qualitative analysis. Before you go ahead with closing Hallam segment or branch, think about what will be the qualitative factors to consider. One, you need to consider about the possible impact on company reputation if you're gonna close one segment in Hallam, because then it means you need to lay off the staff that you have over there. Think about the impact on company reputation and whether you have to prepare for package if you have the permanent staff, quite a number of permanent staff working for you at Hallam branch. Now let's move on to the exercise from textbook. Exercise 13.28. It is keep or drop and constrain resources. The income statement for King Salmon sales, which produce smoked salmon, as follows. So they have revenue from 100,000 kilogram equal to $800,000. And they have list of expenses there. Total expenses $710,000. Pre-tax income equal to the difference, $90,000. Assume that the administrative costs are fixed and that all of other costs are variable. So 150,000, this one is fixed costs and the remaining are all variable costs. The question for you, part A, Suppose the state government curtails fishing because of low fish counts. As a result, king salmon sales can buy only 50,000 kilograms of salmon this year. Assume that the selling price, the fixed cost, and the variable cost remain the same as last year. Using only quantitative information, should king salmon operate this year? Explain your answer using calculation. Hint: before you begin, identify the type of non-routine operating decision, the decision option, and the relevant information for this decision. So this is a keep or drop decision, where the option for you is first, there are two options, whether to produce salmon or not to produce salmon this year. Which one of those information relevant to your decision? Price $8 per kilogram, so that is relevant, and then variable cost per kilogram, $5.60. It is calculated from 200,000 plus 20,000 plus 30,000 plus 300,000 plus 10,000 divided by 100,000 kilogram that you will usually produce per year. So contribution margin is the difference between price and variable cost per unit or per kilogram in this example, equal to 2.4 dollar per kilogram. Remember, admin cost is fixed cost. Hence, you don't need to include that in this calculation because it's irrelevant. At sales of 50,000 kilograms, the contribution margin will be 2.4 times 50,000 equal to $120,000. Fixed costs consists of administration, 150,000. If King Salmon can avoid the fixed cost by not producing, the company should not produce this year. However, if the fixed costs are unavoidable, then it becomes relevant that it should produce because the loss will be reduced from 150,000 to 30,000. Even though they will not generate enough total contribution margin, but at least it can still help to cover the fixed cost, even though it's not the whole fixed cost that can be covered. Part B. Assume king salmon can buy up to 70,000 kilograms of fish at $2 per kilogram, and then that the remainder of the fixed and variable costs remain the same as last year. Also assume that the selling price remains the same as last year, and then the market will purchase at least another 30 kilograms of fish. If the managers of King Salmon wish to sell more salmon, what should they be willing to pay to purchase more fish? In bracket, hint. This type of decision is different from part A. Before you begin, identify the type of non-routine decision, the decision option, and the relevant information. Now, this scenario is different from part A because this is a constrained resource problem, and the general rule is that managers are willing to pay what they pay now plus up to the entire contribution margin. Right now they are paying $2 per kilogram per fish, and that the contribution margin is 2.4. So they are willing to pay up to 4.4 per kilogram for more fish. This assumes that the demand does not change and that future supply prices will not be affected by this decision. So that's the end of this type decision making. Let's continue on the next one. This type is whether you sell the product or process it further. Some industry simultaneously produce a group of products through a single process. If in the process of making one product, one or more other product or services are created, these are called joint products. Well, in this type of situation, then managers often must decide whether to sell a product at split of point or to process it further before selling to the market. Joint costs are all of the costs incurred to jointly produce a group of goods. These costs are common to all of the joint products and are incurred prior to the split of point. The split of point is the point at which you can identify individual products. When making decision about whether to process a joint product beyond the split of point, the joint costs are irrelevant because they are sunk costs. Once manager decide to produce a group of joint products, the joint costs are unavoidable and therefore irrelevant for making product emphasize decision that identify the final products from a joint process. The product with the highest incremental contribution is the most profitable and should be emphasized in this scenario. Example: the Chocoholic company processes cocoa beans. Who doesn't love chocolate? I love it. The first phase of production results in the production of cocoa butter and cocoa powder. The cocoa powder can be sold to other companies or it can be processed further into instant cocoa mix. The costs and revenues are shown below. Should Chocoholic sell the powder or process it into instant cocoa mix? Further information: costs. Cocoa beans cost $500 per batch. Processing cost for phase 1 production that will result in powder and butter $600 per batch. Production cost for phase 2 production that is instant mix $800 per batch. So let's stop for a little while here. So where is the split of point? So that's the first thing that you need to consider. I think the split of point is the phase 1 production because after phase 1 production you can identify two type of joint product, powder and butter. Then powder, you have option whether you can sell the cocoa powder or you process it further in phase 2 production to create instant cocoa mix. Therefore, your cost up to the end of phase 1 production, this is the joint cost. So how much is the joint cost? $600, that is phase 1 production per batch, plus the direct material $500 per batch for cocoa beans to be put in the production. Remember, joint cost is not relevant. Revenues: cocoa butter 750 per batch, cocoa powder you can sell it $500 per batch, instant cocoa mix 2000 per batch. So let's calculate. If you want to sell at split of point, sales revenue from cocoa butter 750 and you can sell cocoa powder $500. If you want to process it further into cocoa mix, you still have two types, cocoa butter at the same selling price $750, cocoa mix $2000 after you process it further from cocoa powder. Minus cost, joint costs, you need to take that out of the calculation because it's irrelevant, 1100 from what we identified before. Processing mix cost, that is phase 2 production, $800 per batch. So the profit for these two different alternative option, if you want to sell at split of point, your sales will be 750 plus 500 minus the joint cost 1100. So the profit for phase 1 production is 150. But if you want to process cocoa powder into instant cocoa mix, your sales revenue will be 750 plus 2000 minus cost, joint cost, and processing mix cost $800. That the profit equal to $850 in this instant. So based on quantitative analysis, you'll be better off by processing cocoa powder further into instant cocoa mix. For sales or process further, please have a look at exercise 13.33 as your self-study. Let me stop here for now to give you time to digest this information. We'll continue in part 3 of the lecture.